field of economics. And then we decided that if we want to understand economics in a better fashion, we must understand some basic concept around this particular subject, such as what is this fiscal policy, what is this monetary policy, what do we mean by when somebody says RBI will give money to the government, or when somebody says is the issuer of currency, etc., etc. So to understand all these basic concept, over to you, Abhinav sir.
Okay. Hi. So what I was thinking is we had a couple of topics left from yesterday. Hello.
Yes, sir.
You
Yes.
hear me? Okay.
Yes.
So I'll just share that one second. I'll just share that first. Then we'll go on to the basic concepts in eco. Okay.
Sure.
Second. Is this screen share visible?
It is.
Okay. So we'd almost done pretty much everything yesterday. We just left with two topics that are broad enough to probably be asked in your exam. So the first one that I want to discuss is about the national infrastructure pipeline. Okay, so this has been also in the news because a lot of people have been talking about it. Our prime minister also announced this. Then our finance minister also, as a part of what's going to happen in the next 5 years, she outlaid a plan, and then she also put this forward. Okay, so Ministry of Finance officially released the report of a task force on the national infrastructure pipeline, and they said that there are certain things and there are certain investments that we want to make in India, okay, over the next 5-6 years, and these are essential to make sure that the economy continues to be on a booming trend. Okay, so now under the national infrastructure pipeline, the government of India has identified a set of projects, and they've said that they will effectively be spending about 102 lakh crore rupees by the year 2025 on infrastructure projects. Okay, so primarily these would be roads, highways, bridges, dams, etc., which are generally needed in an economy, because if you have better roads, then you have your cost of, let's say, logistics goes down. If you have better connectivity, then your cost of transportation goes down, and that effectively makes goods cheaper for, let's say, our exporters and for the people in the market as well, and therefore they have more money in their portfolio to spend on multiple things. Therefore the diversity in terms of consumption and economy continues to be wider, and that would help us generally to A, have a better economy in terms of your GDP, etc., and B, also to have a more diversified economy, so that if there are certain sections of the economy that face a hit, it's not, and then we don't go into a situation like Venezuela currently is facing, where they are primarily dependent on natural gas, and that was the oil and natural gas, and that was the only resource that they had. So if we have a national infrastructure pipeline, then we can have a lot of other economic activities in India, and therefore we will diversify our economic portfolio. Okay, so as a part of the national infrastructure pipeline itself, there is another department called the Department of Promotion of Industry and Industrial Trade. Industry and Internal Trade. Okay, so they have come up with this portal called the India Investment Grid. So basically the India Investment Grid is it's like a collation of investment options across India on a single interactive platform. Okay, so effectively what the government is saying, they're saying that we will invest 102 lakh crore rupees, but obviously that's not going to be enough. There will always be a need of immense amounts of money in the Indian infrastructure sector, and for that the government would probably enter into PPP, public-private partnership models, where, let's say, the government will put in 40%, 50% of the money, and they will encourage a private entity to put in the rest. Or sometimes the government might identify that there are some roads, let's say if you are building a road between, let's say, Delhi and Chandigarh, now it's almost guaranteed that there will always be a consistent flow of traffic between Delhi and Chandigarh, so you can have a private entity build that road, and then the private entity collects tolls on that road, and therefore it's basically like an investment that private entity makes, and then that entity can recover the investment and also make some profit by taxing the vehicles that are plying on the roads, right? So it frees up a lot of government funds to, let's say, make roads on the India-China border, because no private entity is going to do that, because there won't be a lot of traffic on that road, right? So the potential to recover the investment that is made will also be less. So only Government of India can make such investments, because the Government of India has a strategic low role as well, which no other private entity would have, right? So to make sure that this shortfall in funds is accounted for, the DPIIT has released a portal called the India Investment Grid, and it effectively lists all the projects under the national infrastructure pipeline, and it connects a lot of potential investors, builders, and people with money to these projects, so that they can choose. So it's basically like a shopping website, right? It's basically like an Amazon for infrastructure project. Let's say I am an investor, I am a builder, I have a highway construction company, and then I want to see where all I can invest and make money. So I will go on to the India investment grid. So for me, it will act like an Amazon or a Flipkart for projects that I want to invest in, and it will showcase me all the different projects that I can invest in and make money. Okay, so this is the general plan under the national infrastructure pipeline and the India investment grid. Now, another topic that I want to talk to you about is contract farming. So if you guys have watched my video on the agriculture crisis, one second. Yeah, so if you guys have watched my video on the agriculture crisis that we face in India, I talked to you about the role of the APMCs, okay, Agriculture Produce Marketing Committees. Okay, so the idea behind APMCs was that earlier on, let's say in the 50s and 60s, the government was worried that the big money lenders and big contractors, etc., would dupe the farmers, and therefore they would buy goods for cheaper from the farmers and then sell these goods at a higher price to the normal public. So it was harming the interest of the farmers, and it was also harming the interest of the public at large. So therefore they decided to come up with an act called the APMC Act, which basically mandated that there would be APMCs or mandis in every let's say district or state, and the number of mandis in every state in India, and the farmers are obligated to make sure that the first sale of their produce will only be in the mandis. So the idea was so that the contractors and the middlemen could not go to the farms, and they would so that they could not effectively go to the farms and then give lower prices to the farmers, because the farmers would not be aware of what the rate in the market was, right? So the price discovery mechanism was inadequate. Now, to reset that, the government said all the farmers will have to come to the mandis. In the mandis, all the traders all the middlemen will also have to come to the mandis, and they will buy products from the farmers in the mandis. So once all the farmers are gathered in the mandis, they would be in a better position for, let's say, price discovery, in the sense that they would know what is the adequate and actual and the apt price for their produce, right? So India being India, that model worked for a while, and then that model also got corrupted, and so the middlemen started colluding with each other. They wouldn't outbid each other in terms of auctions, and they started robbing the farmers there as well, right? Just say, for example, recently we saw that onions are selling for 100 rupees a kg. So the farmer who's produced those onions, he's probably sold them for 10 rupees a kg, and you as a consumer are buying them for 100 rupees. It's the middlemen who are making 90% of the money, right? So that's one of the problems with the APMC. If you want to see the problems with Indian agriculture, you can go back to this video that we did, wherein we effectively basically concluded that Indian agriculture has a lot of other problems, which are basically because of well-meaning policies of the government that the government of India has enacted, but it has now, the time has come for these policies to be done away with. Okay, so one step that the government of India has taken is by introducing the concept of contract farming. Okay, so contract farming effectively means that now I will make sure that the farmers not have the obligation to go and sell in the mandi, that it's not compulsory for farmers to go there and make the first sale. I, as an independent party, can go to a farmer, and then I can go to a farmer and say that boss, let's say I'm Lay's, the chips manufacturing company, right? So I can go to one farmer or a group of farmers or a large group of farmers, and I tell them that, here boss, take these seeds. I want my potatoes to be this dimension, this size, and this quality. If you can produce those sort of potatoes for me, then I will buy those potatoes from you, and you will not have to go to a mandi, and I will also not have to go to a mandi to buy that. So effectively, we will eliminate all the middlemen, and we will do a direct transaction. So under the APMC Act, it wasn't allowed. However, Government of India in 2018 came up with the Model Contract Farming Act. Okay, and then they included basically all categories of horticulture and agronomic crops, livestock, dairy, poultry, fishery in the act, and effectively allowed for contract farming. Okay, so now Punjab has a separate law on contract farming. You can read about this act from any of the current affairs sources. I'm not going to go very specifically into this. What is current in this scenario is that Tamil Nadu has become the first state in India to have a contract farming law, which is modeled along the lines of the Model Contract Farming Act. Okay, so the reason why the Contract Farming Act is not a central act is because contract farming is under concurrent list, while agriculture is under state list, right? So center cannot make laws for agriculture. It's under the power to make laws vis-a-vis agriculture rest with the state, right? So if you have a basic understanding of the constitution, there are 3 lists in the constitution. Okay, now there is the first list is called the center list. It includes all the subjects on which the center has the power to make the laws. Okay, then you have the state list, okay, wherein it contains all the subjects wherein the state has the power to make all the laws. Okay, so you have subjects like policing and agriculture in the state list, right? And then there is another list known as the concurrent list, where both the center and the state have the powers to make laws. However, if there is an inconsistency between the laws that the center has made and the laws that the states have made, then obviously the center's law prevails. Okay, so these are the lists that exist under the constitution. Okay, now, so you must remember that contract farming is under the concurrent list. Both the state and the center can make a law. However, agriculture is under the state list. Okay, so now the state, under the Model Contract Farming Act, which Tamil Nadu has also adopted and made a contract farming act of its own, it has given some exemptions to the parties that are engaged in contract farming. Okay, let's say, for example, they are exempt from licensing and restrictions on the stock limit and movement of foodstuff under the Essential Commodities Act. So the Essential Commodities Act also is a very important act, in the sense that Essential Commodities Act basically tells you that there are certain essential commodities, like, let's say, medicines, food grains, tomatoes, potatoes, whatever, anything can be included under that list, and the government issues and regulates those things, right? So let's say so the government basically uses the Essential Commodities Act to make sure that farmers, or that traders and middlemen, do not hoard essential supplies and then therefore create an artificial demand and then try to sell it for an expensive price, right? So under the Essential Commodities Act, by executive order, the governments can basically tell these warehouse owners, etc., to make sure that their warehouses are empty of all those goods, right? So let's say if the onion prices are rising to the tune of 100 and 200 rupees a kg, then under the Essential Commodities Act, the states can order all the godowns and warehouses to offload their onions in the market, so that normalcy can be restored, and so that the high demand for onions, which is causing this increase in price, can also be suppressed. Okay, so now if, let's say, I'm a party which is entering into contract farming, then obviously these conditions cannot apply to me, because let's say I am a company, I am Lay's, right, and I enter into a contract with a farmer or a group of farmers to make potatoes for me, then obviously I'm going to need these potatoes over 1 year's time, right? I'm not going to use all the potatoes and then make the chips as of now itself. Like, I also have a limited capacity to produce these chips. So the reason why a lot of people weren't into contract farming is because they thought that they might pay the farmers X amount of money and then they would buy from them. Then the state would come in and say that under the Essential Commodities Act, we're issuing an order whereby you have to empty your godown. So obviously, me as a company which is engaged in contract farming with farmers would stand to lose out. However, that has been remedied now, and the parties to contract farming are basically, let's say, exempt from the Essential Commodities Act. Now, another very interesting thing that the Supreme Court has done is that the Supreme Court has said that, so basically, mostly in terms of contract farming, if I as a company engage some farmers for contract farming, then I would obviously want those farmers to produce a certain kind of fruit or a certain kind of food, right? Because that food has to match my requirements. Now, one of the ways that I do this is that I give these farmers seeds on my own, right? So the Supreme Court has said that if there is a relationship like this between the farmers and the company, where the company is giving seeds to the farmers and then the farmers are selling the produce back to the company, then the farmers are covered under the definition of a consumer. Okay, this is what the Supreme Court has said. So once the farmer in this sort of a relationship is covered under the definition of a consumer, then all the protections that are given to consumers in general under the Consumer Protection Act are become applicable to this farmer as well. Okay, now obviously contract farming, as I told you earlier, also remains outside the ambit of the Agriculture Produce Marketing Committee Act or the APMC Act of the states and union territories, obviously, right? Because the APMCs mandate that the first sale has to be in the mandis. But obviously, if you engage in a contract for farming, then you will not go to the mandis. The whole point of contract farming is to eliminate the mandis and the lots of middlemen that come in here. Okay, so this is that we had pretty much left from last time vis-a-vis your current affairs. Now, I think a lot of people last time had some issues with regards to, one second. So yeah, so last time I think some people had issues with regards to, let's say, certain basic concepts in economics. So Harsh has been very kind to make certain slides for us. Harsh, is this visible now?
Yes, sir, it is visible.
Okay. But I also want to, 1 second, where is the chat box? So I have enabled the chat box. I can see your chat box now. So if you have any queries, then you can ask them to me, okay? So let's talk about some basic concepts in economics. So if any of you have done your economics in class 11th and 12th, then this will not be a big deal for you, because you generally would, I'm assuming you've done a good job and you studied economics at that point of time. So these basic concepts would be clear to you. But this session effectively is for people who did not have economics in their 11th and 12th, and they might face certain issues vis-a-vis understanding the basic concepts of economics when they're reading newspapers and when they're trying to compile current affairs pertaining to economics. Okay. So the first thing that we want to discuss here is gross domestic product and the gross national product. Okay. So I'm simplifying it to a very large extent. Gross domestic product basically is the value of all the goods and the services that are produced in an economy in, let's say, 1 year. Okay, so anything that is produced in India, or any service, any goods that are produced in India, the final value of all these goods and services is basically the GDP, or the gross domestic product of the country. Okay, now obviously the thing is that there are certain goods that are being manufactured in India, but that those goods are as in that's not effectively the income that is accruing to all Indians, right? Let's say, for example, recently we read the news that Samsung, etc., has decided to set up a manufacturing plant for mobile phones in Uttar Pradesh. Okay, so now any mobile phone that is being manufactured in that plant is going to be sold, and the final value of the product, as in final value of that mobile phone, does get added to the gross domestic product. However, it does not become income in the hands of all Indians, because this money is obviously paid back to Samsung and its shareholders, who might be people in Korea, or generally people from other countries who have invested in the shares of Samsung, right? So this concept wherein you eliminate all the, let's say, income generated value of goods and services produced by nationals of other countries or companies of other countries, then that whatever is left later on is known as the gross national product. Now, apart from this, obviously, there could be some investments. Let's say Tata Motors, we know, has acquired Jaguar and Land Rover. So anything and all the cars, all the Jaguar and the Land Rover and the Range Rover cars that are sold in the UK or in Europe or globally would not become a part of the gross domestic product of India. They would become the part of the gross domestic product of that home country. However, when we decide, and however, let's see where the income is coming, right? So for every Range Rover and Land Rover that is sold, some income comes back to Tata Motors, which is a company which is based in India, and Tata Motors is an Indian company, right? So anything that is sold by Jaguar and Land Rover would become a part of the gross national product here in India. It won't be the part of the gross domestic product in India. It would be a part of the gross national product in India. So sometimes you read these two terms in the newspapers wherein they talk about GDP and gross national product. So sometimes these are a little confusing for people. Okay. So next thing that is generally there in the papers is this term called monetary policy. Okay. So the thing is, in every economy, there is obviously the responsibility of the governments to regulate the economy, right? Now, there are two ways in which governments in every country, let's more specifically India, they take certain decisions, and there are two ways two ways whereby they influence the economic decisions that other factors of production in the economy make, right? So one is through the monetary policy and the other is through the fiscal policy. Okay, so fiscal policy pertains to basically the policy of taxation and spending of the government. So let's say the government wants to raise the income tax, the government introduces GST, it wants to change certain rates of income tax, that would fall under the fiscal policy, right? Because that is pertaining to taxation and spending of government. So let's say tomorrow that we talked about the national infrastructure pipeline, right? So the government has decided to spend 102 lakh crore rupees on infrastructure. So that is a part of the fiscal policy. Okay. Now the other way that the government regulates this is through the RBI. Okay. So RBI is basically the entity which is responsible for making decisions vis-a-vis money. So anything vis-a-vis, let's say if there are decisions with regards to raising the interest rate, reducing the interest rate, and yesterday we read about how the merchant discount rate for your RuPay and UPI cards has been done away with. So anything and everything related to money specifically is known as the monetary policy, and that is the sole domain of the Reserve Bank of India. Okay. So now another very important component, one second. Yeah. So another very important component of an economy is the banking system, right? So RBI's primary job, apart from issuing monetary policy of India, is also to regulate the various number of banks that exist in India. Okay. So the RBI has certain rates, the RBI has certain policies whereby how it does, so using which it does and it regulates all these banks. So let's look at these policies in a little detail. So the first thing is the repo rate. Okay. So repo rate basically means the rate at which Reserve Bank of India gives a loan to other banks in India. Okay. And then there is another thing called the reverse repo rate. So reverse repo rate effectively means the rate at which RBI borrows money from the commercial banks of India. Okay. Now, let me tell you what CRR and SLR are, and then this repo rate and reverse repo rate would become more relevant for you. You would have seen these terms in newspapers that RBI has slashed the repo rate or the RBI has increased the repo rate. So what sort of implications it can have on the economy? Let's first look at what CRR and SLR are, and then we'll understand these things. Okay. So RBI basically has two guidelines for banks. Banks are supposed to maintain two very important ratios. The first ratio that we mentioned here is the CRR or the cash reserve ratio. And the second ratio that I want to talk to about is the SLR or the statutory liquidity ratio. Okay. So very simply put, cash reserve ratio is the amount of money that every bank has to deposit with RBI. Okay. It's a percentage of the total money that the banks have lent out. So the idea, so that's how banks work, right? So let's say banks will take 100 rupees from me, then the banks will give me 5% interest in 1 year. However, the banks would want to use that 100 rupees and lend it to a business at 10%. And the difference between the 5% the banks makes from me and the 10% that the bank makes from the business is effectively that 5 rupees that the banks make is the profit. Right. So if there was no RBI, then the banks would basically say that if Abhinav is giving me 100 rupees, I'm going to lend all of these 100 rupees to a company so that I can make a profit. Right. But RBI doesn't want to do that, because let's say if tomorrow I go to a bank and say, okay, now I really want my 100 rupees back. There is an emergency. I need my fund back. The banks would then say, no, we thought you will come back later and we just don't have the money to give you back. Right. So that would cause a crash in the financial system. Now, to mitigate that, the RBI says that the banks have to maintain a certain deposit of cash with the RBI known as the cash reserve ratio. Okay. Now, similarly, the RBI says that apart from maintaining a healthy cash reserve ratio, another thing that the banks have to do is that they have to maintain a specific statutory liquidity ratio. So the statutory liquidity ratio basically is that the banks have to maintain a certain class of assets. These could be government securities, sovereign bonds, or other such securities that the government of India or RBI has specifically dictated, right? So banks have to maintain two things, CRR and statutory liquidity ratio. Okay. So now, that I hope you have understood these basic terms. Those are CRR and SLR. Let's see how these effectively work, right? So let's say the cash reserve ratio is X%, right? So banks are supposed to keep X% of money in deposits, and they have 100 minus X only to lend, right? So let's say the RBI says that, okay, I want banks to lend more money. The banks are not lending more money. So the RBI then says that, okay, I will reduce the cash reserve ratio. So now RBI says that the cash reserve ratio is a little less than X, which means that more funds are freed with the bank, and the banks can use more of these funds to lend to other companies and therefore boost the economy. Now, the RBI can do the converse of this. If the RBI thinks that the banks are lending too much money and therefore that is causing some form of an inflationary pressure in the economy, then the RBI could increase the cash reserve ratio, and therefore the banks would then not have enough money to lend out to the other corporates, and that would somehow curb inflation. Okay. Now, RBI can either do this directly by altering the CRR or the SLR, but that's something that RBI really doesn't do. What RBI can sometimes effectively does is that it twinkles with the repo rate and the reverse repo rate. Okay. So the idea of CRR, or the cash reserve ratio, is basically that the RBI is the banks are supposed to have certain cash with them, so that when their depositors come and demand money from them, the banks can use this cash to pay off their depositors, right? So now the repo rate I told you is the rate at which the central bank, the RBI, gives loan to these banks, right? So let's say the repo rate is so let's say if the RBI wants these banks to lend more money to corporates, what RBI can do is RBI will say that, okay, I will reduce the repo rate, which means that if banks at a later date or want to, let's say, borrow money from the RBI to pay back these depositors who might come suddenly and would ask money from the banks, then obviously there would be certain calculations that the banks are making, right? So obviously, let's say the banks are going to lend at an 8% rate to a borrower, and the RBI says that the repo rate is also 8%. So at this point of time, the banks are indifferent. They can either keep and maintain a healthy cash reserve ratio, or they can go to the RBI and borrow, because at both junctures, the cost of the fund is 8% only. However, if let's say the RBI says that, okay, I want banks to lend more money, so RBI says that I will reduce the repo rate to 6%. Now, the calculation that the banks will make is that if I keep this money with me in the form of a reserve ratio, then I stand to lose out on the 8% profit that the company might give to me. And if let's say if I give the money to the company and I make an 8% profit out of it, and if suddenly there are certain depositors who come to me and then they start asking for this money, then what I can do is I can go to the Reserve Bank of India and then I can borrow at a 6% rate. So effectively, the banks are going to net out that 2% profit, right? So that's how RBI manipulates how much the banks are going to lend to companies in the economy. So similarly, if the RBI wants the banks to not lend money, then it increases the repo rate, right? So therefore, the banks say that it is now, if the repo rate is 10%, okay, and the profit that they would have made if they had lent out this money to a corporate would be 8%. Now the banks would say that if let's say tomorrow the consumers come and start demanding money from me, I will make an 8% from the money that I give to this company. However, I will have to borrow from the RBI at 10%, and therefore I will incur an effective loss of 2%. Okay, so I hope this is a little clear vis-a-vis how RBI, using its monetary policy, manages certain decisions of the banks, right? Because effectively RBI's primary job is to act as a banker of banks, and it is to act as a regulator of banks, right? So I hope this is a little clear to you. 1 second, there's a chat as well. Okay, yes, understood. Okay, cool. So the next thing, so the other thing that I want to talk to you about here is the fiscal policy, right? So everything that is to do with money, every decision that is taken by the RBI vis-a-vis the money is through the monetary policy. Then obviously government of India also can influence the sort of mood in an economy. It can boost production, etc. by its policy measures known as fiscal policy. Okay, so fiscal policy basically deals with taxation and spending. Okay, so let's say the government of India decides to increase government spending, right? So let's say government of India wants, so let's say today government of India is making 10 rupees in tax payments. Okay, so the government of India decides that I will invest another 100 rupees in the economy. So the moment the government of India invests 100 rupees, it leads to better roads, it leads to better infrastructure. That means that more laborers are required to make those roads. Therefore, the companies are going to pay those salaries to the laborers, right? And similarly, there would be a more of an economic activity that is there in the country, right? So let's say the roads would then reduce the cost of production, and the companies would produce more things. The companies could then, because the cost of production is reduced, could export these goods to other countries and make money from there. So let's say the government spends 100 rupees, right? And it would lead to, so now these laborers have to be paid money, laborers have to be paid money, a lot of officers and managers have to be paid money. Now they will get more salary, and then the government of India will get more, let's say, taxes in terms of income tax. So for every 100 rupees that the government of India spends, it might be able to realize more taxes. Okay, so that's one of the policies that the government of India works for. So the government thinks that if I spend 100 rupees today, and I am receiving 10 rupees in income tax every year. Maybe if I spend 100 rupees today, 25 years down the line, I'll be able to make 15 rupees, 20 rupees from income tax, because the general GDP and the growth of the economy would have started, and therefore people would have started earning more money. So this is one way that the government regulates. The other thing is it can obviously increase or decrease tax rates. So let's say if the income tax rate is 30% and government of India decides that, okay, I want people to buy more things. Now the easiest way for government of India to do this is to reduce income tax from 30% to 20%. So if I was earning 100 rupees and I was paying 30 rupees in taxes, I was only left with 80 rupees to spend, right? Now, if on the other side, the government of India says, okay, now you need to pay only 20 rupees. So I am now left with an additional 10 rupees to spend. Now, when I spend that money in the economy, it will obviously have a multiplier effect, and that will boost the economy. Okay, so this is how the fiscal policy works. Now, there are certain terms that you might see in newspapers. So the first term is bond yield. I really don't think that issue. I don't think that it'll ever be asked to you in an exam. So effectively, so we discussed in yesterday's lecture what bonds are. So effectively, the sort of interest that you get on a bond when these bonds are traded on the open market, because bonds by nature are instruments that have fixed coupon rates, right? So let's say government of India says that my face value of my bond that I'm putting out in the market is 100 rupees, and the coupon payment is 5 rupees, which means every year I will pay 5 rupees to the holder of these bonds. Okay. Now, once the government of India issues these bonds at 100 rupees, 5 rupees the coupon payment, then these bonds become tradable in the open market, right? So if let's say people think that they want to invest more in terms of bonds, then they will start buying these bonds. So the cost of the bonds in the stock market, which was 100, would increase, because if more, it's the simple principle of economics, right? If there is more demand and if there is less supply, then the price would increase. Now, when the price of the bond increases, the yield of the bond reduces, right? Because obviously, if let's say someone's buying that bond at 101 rupees because he believes that the markets are not going to be stable and government of India bonds are the only bonds that will be able to give me some return, right? So he will buy that bond for 100 rupees, 101 rupees. However, the coupon rate is a fixed 5 rupees, right? So he'll only be making a profit of 4 rupees over there. So that effective rate of interest is basically the bond yield. Okay. Then you have concepts like fiscal deficit. So fiscal deficit basically, so obviously if the government, so the reason why government is spending money is because it is making money through its taxation policies, right? So whenever, let's say if the tax collected by the government is more than the money that the government is spending, then obviously the government is running a surplus, right? So that would be a fiscal surplus. However, if the taxes that the government is collecting is less than the money that the government is spending, then that condition is known as the fiscal deficit. So there is an act called the FRBM Act, which effectively mandates that the government should maintain a fiscal deficit of about 3%. Now, fiscal deficit of 3% is generally understood to be good, because the thing is that if let's say the government is spending more than it is getting from taxation, it will obviously have to borrow this money from, let's say, the people in the economy itself, internal borrowing, or it might borrow from other multilateral international agencies. However, the fact that the government is spending that extra money would have a multiplier effect, and at a later date the tax revenues of the government would increase. So a healthy fiscal deficit that government should maintain is around 3%. So you would have heard of this term that the government wants to reduce its fiscal deficit to 3% from 3.5%. So that is effectively what the government is trying to do. Now, in terms of fiscal deficit, there could be two reasons as to why there is a deficit, in the sense that why the revenues are lesser than the government spending. Now, one is a cyclical fiscal deficit, right? Now, anything cyclical means that it moves in cycles. So let's say the economy is booming, then obviously we will not be in a fiscal deficit, because the revenue that the government is earning would be more than the money it is spending. However, let's say in specific times like the times of coronavirus, obviously the GDP of the country is down. Obviously, there is not enough production in the market. So the taxes that the government is going to realize will also be less. But there are certain expenditures that the government has to do. Government has to do defense expenditure, government has to spend money on health, the government has to spend money on education, right? So in certain scenarios like this, in certain cyclical scenarios like this, obviously the fiscal deficit would increase because there is low productivity in the economy, right? Now, this is called as a cyclical fiscal deficit. There is another term which is known as, There's another term which is known as structural fiscal deficit, right? So as I told you, fiscal deficit could be because of cyclical events like this. However, structural fiscal deficit means that when all conditions are equal, when there is nothing disruptive in the economy, there are still certain deficits that the government is incurring because of maybe the bad policies that it has, right? So the deficit which is there, which is not related to the economy, which is not a part of the economic cycle, that deficit is known as the fiscal deficit. Maybe the taxation policy of the government is bad, maybe the government is spending way too much money, and if and probably that money is being dwindled away in corruption. So that is another issue. If it's not reaching its intended source, then it can't produce a multiplier effect. So these things would contribute to the structural fiscal deficit, which is independent of the economy. Okay. Now, there are two other terms that I see here, which are direct taxation and indirect taxation. So it's fairly easy. Direct tax is basically that the tax that is directly paid by me. So income tax would fall into this category. Let's say I am earning 100 rupees and the government says, okay, 30% tax. So I am effectively earning only 70 rupees, and 30 rupees is something that I have to give to the government. So the taxation is directly on me, right? Now, another component of taxation is the indirect taxes, like your GST, right? So I am effectively not paying. The vendor who's selling the good to me, I pay that extra money to him, and then that vendor pays the GST, right? So in an economy, there has to be a balance between direct taxation and indirect taxation. Now, direct taxation, if there is more of direct taxation, then it is said to be a progressive tax-based economy, right? Because direct taxation is based on how much money you earn. Okay, so let's say I'm someone who's earning 1 crore rupees. I will pay 35% income tax. Okay. Now, however, if I'm someone who's earning, let's say 10 lakh rupees, then I'm obligated to only pay 20% income tax, because the government believes, and rightly so, that I need 80. So to me, 80% of 10 lakhs is more important than 70% of someone who's making 1 crore rupees, right? Because that person is rich and he's most effectively not going to use that money for consumption expenditure. Most likely that money is going to savings. Now, similarly, the government also says that if you're earning less than 5 lakh rupees, tum apna hi dekh lo, tum desh ko tax mat do in terms of direct taxes, right? So therefore, direct taxes are said to be, if there's an economy which has more direct taxation, that economy is said to be a more progressive economy, because the burden on indirect taxes is proportional. So if I earn less than 5 lakh rupees, I pay 0% tax. If I earn between, let's say, 5 to 10 lakh rupees, I don't know what the income tax slab is. I'm giving a hypothetical example. Then I pay 20% income tax. Now, if I earn like 10 crore rupees, then I pay 35% income tax, because obviously that money is not as important to me as it is to someone who's making 5 lakhs. Now, the other side to this is indirect taxes, right? So let's say there is a Parle-G biscuit which costs 10 rupees. Out of that, 1 rupee is a GST on the Parle-G biscuit. Now, someone who is making 1 crore rupee, when he wants to eat that Parle-G biscuit, has to spend that extra, has to give that 1 rupee tax. And someone who's earning 3 lakh rupees a year, when that person also wants to eat a Parle-G biscuit, he also has to pay that 1% tax. So therefore, indirect tax, when there is more of let's say indirect tax in an economy, that is not said to be a progressive economy, because obviously the tax burden of 1 rupee on a Parle-G packet for someone who's earning 2 lakh rupees a year is way more than the tax burden of 1 rupee on someone who's earning, let's say, 1 crore rupees a year, right? So I hope you understand the difference between direct taxation and indirect taxation, and why direct taxation is said to be the more progressive form of taxation. Okay. Now, there is this another concept that I want to talk about, which is basically the balance of payment, right? So obviously we live in a globalized world. I will produce certain things in India, right, which might be in demand in other countries. Some countries, like let's say Apple, etc., might make products in their own countries which would be in demand in India, right? So obviously there would be transactions that happen at an international level. So the central banks of the countries will be responsible for settling these transactions, right? So effectively, whenever foreign currency comes into my country, that is a positive entry. If I sell more things outside and get more foreign currency, that's a positive entry. At the same point of time, when I use my own money to buy goods that are made in or originate in a foreign country, that's a negative let's say a negative entry, right? Because I'm sending out rupees from this country. So the balance that exists between these to transaction is known as the balance of payment. Okay. Now there is this concept of inflation and deflation. So inflation is when the right price, then when the prices of the goods are rising. Okay. Now there can be two reasons for any form of, let's say, inflation. Now the first type of inflation is cost push inflation, right? So let's say the cost of production of goods in an economy rises. Therefore, for me as a company to continue making the same amount of profit, I will have to increase the prices of the goods. Okay, so that would be the cost push inflation. The second and the more common form of inflation would be the demand pull inflation, right? So let's say I as a company, I'm making only 100 shoes. Now, if there are, let's say, 100 people in the economy, it's okay. Everyone wants a shoe. I will sell that shoe at the market rate, right? Now, suddenly, if let's say at some point in time, 110 people want to buy the 100 shoes that I'm making, then obviously I will sense that I can probably sell my shoes at a premium, because now there is a competition amongst the buyers for buying my good, right? So the demand of the good is more than the supply of the good that I'm giving, and therefore this sort of an inflation is known as the cost pull inflation. Now the opposite of inflation is deflation, right? If the price of the goods is decreasing, let's say for example in the same shoes example, let's say I as a company, I am making 100 shoes, but only 90 people in the market really want to buy these shoes. Okay, now so only 90 people in the economy want to buy these shoes. Okay, so then obviously the demand is lesser than the supply, and now the buyers realize that if we don't buy, then this company itself will be forced to give discounts of some sort, and therefore the cost of goods would be decreasing. Okay, one second. One second. Okay. So Praveen says, please tell about bottleneck inflation. Okay. So let's say in this particular scenario, bottleneck inflation basically is the sort of inflation wherein the supply cannot increase to match the demand, right? So suddenly, let's say the demand of a good increase. One second. Sorry for Okay, sorry. Okay, so bottleneck inflation effectively means when the demand remains the same, but the supply is very, very restricted, right? So let's say tomorrow government of India makes a policy and says that, let's say there's a company which is making shoes, okay? And the government of India comes tomorrow and says that, oh, this company has to give 90 shoes to me because I need to give these shoes to the soldiers at the China border, right? So in that short run, the company is unable to, let's say, increase its supply, because anything incremental that the company is going to produce will go to the soldiers at the border. So the company will only be left with these 10 or 20 shoes. Okay. So now the demand in the market is more, but the supply is not able to increase, maybe because of any government intervention, or maybe because of, let's say, there is no other producer of shoes in the economy, and that's the only company that can produce shoes. And the company can only produce X number of shoes in the market, irrespective of the demand. So when there is a bottleneck in terms of supply and the demand continues to remain the same, that sort of inflation is known as the bottleneck inflation. I hope it's clear to you, Praveen. Okay. Okay. Yeah. So then there is another term known as recession. Okay. So we've have a broad idea about GDPs. GDP is the sum of all the final price of the goods and services produced in an economy, right? So you must have been reading newspapers, and recently it said that England is the first major country to go into a recession because of the coronavirus pandemic. Okay. So, and I think the first thing that we read yesterday, the first article or the first current affairs that we read yesterday, was that the Indian GDP is facing a slowdown. It's now growing at a 4.7% rate, which is the slowest in 7 years. Okay. So GDP growth rate is measured in every quarter. Okay. So whenever there is a rate in the decrease of GDP, which means that the GDP growth rate falls for two successive, so there is no hard and fast definition of when a recession exists, but it's a sort of an informal, sort of an understanding between all the economists in the world, that whenever there is a fall in the rate of rise of GDP, okay, whenever there is a fall, let's say whenever there's a fall in the rise of the GDP, okay, then there is this issue of, one second, sorry, whenever there's a fall in GDP for 2 consecutive quarters, then you will face this issue of, let's say, recession, right? And when there is recession which goes on for a much longer period, then that is termed as a form of, that is termed as depression. Okay. So Varesh is asking, why would company not increase the production of shoes if demand is in the market? So sometimes companies just don't do it, right? Because, so let me give you a better example and more relevant example of the oil producing companies in the world. Okay. So recently, if you read the news, there was a meeting recently between the OPEC countries, okay, the oil producing countries, plus some other countries, so plus other countries like Russia and Kazakhstan, etc., which had decided, and this group is known as the Vienna Group, and they had decided to limit production of oil, right? Now, bottleneck inflation generally occurs in scenarios where the demand for good is inelastic, right? So, for example, let's say the example of shoes is slightly, it's a very simplified example because obviously shoes is not something which is very essential to everyone, right? So if, let's say, I want to buy shoes, but if shoes are not available, I can obviously say that, oh, I don't want to maybe pay more money for the shoes. When the demand reduces or whenever the company produces more shoes, I will end up buying shoes. So this demand is an elastic demand based on the prices, right? But there are certain goods in the economy for which the demand is inelastic. For example, fuel, right? For example, crude oil. Now, and India needs certain amount of crude oil. Cars have to keep running, your trains have to run, your trucks have to run, your big factories have to run, and all of these are running on fuel, right? So therefore the demand for fuel is inelastic. Now what these oil producing countries are effectively doing is that they're restricting the production of those crude oil barrels, right? So they're limiting production, limiting supply. Now the supply is artificially low, however the demand is inelastic. If India needs 100 liters of fuel, then India needs 100 liters of fuel irrespective of the price of the fuel, right? So India will have to buy fuel at a higher price from these particular companies, and that in the sense would mean that there is an inflation in the price of oil, right? And that effectively is what is known as bottleneck inflation. So when bottleneck inflation generally exists in goods which are of an inelastic nature. Okay. So Rishikesh Singh says, is there a formula for calculating GDP in all the countries, or every country can set their own? So generally, so if you look at the class 12 economics, there are 3 methods of GDP calculation, right? So you have to understand the principle of GDP, right? What effectively GDP means. GDP means the final value of all goods and services produced in the economy. So there are multiple methods by which you can arrive at it, but there is one very simple method wherein GDP is basically sigma means sum of CIGX. Okay. Now C is the consumption in the economy, I is the net investment in the economy, G is the government spending in the economy, and X is the balance of import and export. So effectively GDP calculation will remain the same in the sense that the broader formula that all the goods and services that have to be calculated in an economy will continue to be the same. However, the reference point for your GDP can change, right? So let's say a country says that I will calculate GDP on the basis of the prices that were there in 2001, right? Because, like, for example, let's say GDP is calculated every year, right? However, the prices of goods are not consistent every year. Some years, some goods are expensive. Some years, some goods are not very expensive. So some countries can say that, okay, we will calculate GDP based on 2011 ka prices. Now another country will say, no, I will calculate GDP based on 2008 ka prices. So the reference period for this would be different. However, effectively the formula has to be the same, right? Because they're calculating the very same thing, the final cost and the final value of all the goods and services produced in an economy. So the formula generally is the same, but the variables that you can use in the formula, the benchmark and the base of reference here, etc., that you use in the formula can be different. Okay. So okay, Rishikesh, you got it? Okay, thank you. So I'm pretty much done with what I had to. Okay, sorry, there is one more thing that I want to discuss, which is the role and the functions of the RBI. So if you have any questions with regards to this specifically, or something that we discussed yesterday, or even from any other videos in current affairs, because I think we have some time, we have like 5-10 minutes, you can ask those questions in the chat and I'll try to explain to you. Okay. So now let's look at the role and the functions of the RBI. Now the first role is that RBI is the issuer of currency. Okay. So if you pick up a note that you might have in front of you, you will see a signature of the governor of the RBI on that note, and the note reads that I promise to pay the bearer this value, right? So why does that so there is a 2000 rupee note, right? Why is that 2000 rupees note worth 2000 rupees? Because the value of the paper on which it is printed is not more than 20 paisa. However, that value of that note is 2000 rupees because it is a promise by the RBI that if you produce this note anywhere in India, you will get a value that the number that is 2000 here is signifying, right? So that's the promise that the RBI gives. So RBI is the issuer of all currency. Okay. Now coins, please remember, are not issued by your RBI. Coins are issued by the Indian Mint. I think there are 4 mints in India. One is in Noida, one is in Bombay, one is in Calcutta, and I don't know the 4th one. You can check it. So RBI only issues currency in terms of notes, not coins. Okay. Then the second is regulation of financial markets, right? So financial markets are inherently complex demons, right? So if you look at the example of stock markets, etc., or bond markets, etc., right? Not everyone's able to understand that. So there is a large scope by manipulation, large scope of manipulation by some people in those markets. So SEBI along with RBI are regulators of the financial market. Then there is consumer education and protection. Now, obviously, it flows from regulation of financial markets and banking services that the RBI ensures that the interest of the citizens of the country and protection of the citizens of the country is paramount. It does not allow banks and financial intermediaries, etc., to cheat these people. Okay, so consumer education and protection is also the role of RBI. So the RBI will keep telling you that please beware of these practices. Please make sure that your money is not stolen from you in such and such manner. Please make sure that these financial intermediaries or banks are not carrying out fraudulent transactions to protect the consumers, right? Then banker and debt manager to the government, right? So as I said, government borrows money, right? So as I said, right, government sometimes borrows money because whenever there's a fiscal deficit, the government has to borrow money to meet up for the deficit, right? So government has to borrow money through something, and that entity through which the government borrows money and the entity that manages the government's debt is RBI, right? So RBI is basically so let's say I have an account in ICICI Bank. Okay, so ICICI Bank is my banker and I take a loan from ICICI Bank. So ICICI Bank is my debt manager. Similarly, Reserve Bank of India is the banker of Government of India because Government of India has its money in Reserve Bank of India, and similarly all and every sort of debt that Government of India incurs is managed by the RBI. Then the 5th is banker to banks, right? So as I told you, RBI also has certain CRR, SLR, then there is repo rate, etc. So RBI borrows money from the bank sometimes. RBI can lend money to the banks. Let's say if the banks have a certain shortfall of liquid cash, then the RBI lends money to the banks. Therefore, RBI is a banker to banks. And RBI is also known as the lender of last resort, right? So let's say there is a bank which is on the verge of bankruptcy and the bank says that, sorry, I don't have money to pay my depositors. Then RBI will, as the final decision, RBI will say, okay, I will give you this money, but I will charge you this penal rate of interest. So the RBI does that not because it is trying to protect the bank. The RBI does that because it is trying to protect the depositors of the bank who are basically citizens of India, right? So RBI is the banker to banks, and RBI is also the lender of last resort. मतलब जब सब खत्म हो जाता है, जब बैंक के पास कुछ नहीं बचेगा, so RBI will step in to protect that bank. And then the last is foreign exchange management, right? So obviously someone has to regulate how much dollars are coming into India, how much pounds are coming into India, how many rupees are going out of India. So all of that management is also done by RBI through certain acts. There are FCRA, or the Foreign Currency Regulation Act, and there is FMA Act, Foreign Exchange Management Act. This is beyond the scope of the syllabus, but you should know that foreign exchange management is also one of the roles and responsibilities of the RBI. Okay. So this is pretty much it that I had. If you guys have any questions, you can quickly ask them. Okay. So Harsh, I'm pretty much done with this.
Yes, sir. I was going through the comments as well, and everybody has understood whatever they asked. And great explanation. That's the point. And there were a few pointers. Bottleneck inflation. Explained it very well. Like anyone layman who has no idea of economics would get that. Thank you so much for doing this for us.
Okay. Bye-bye.
Thank you, sir.